Welcome to the Northern Affinity Video Podcast. During this session, we will be having an unedited discussion with an expert. And what I'll be planning to do is, during our discussion, get them to teach me something. Teach me about something that's of interest, but also they are an expert in. I'm Michael Edwards and I'm the founder of the Northern Affinity. And I will tap into our wonderful community to bring you along on my drive for self-improvement and my desire to learn. So please connect with me on various social media platforms, whether it's LinkedIn or Instagram or Twitter. And I'd love to hear from you what subjects you'd like to learn more about, or what subjects you think it'd be good for me to learn about. So please, get in contact and let me know. All the details will be in the show notes, and you can send me an email or contact me by the various platforms. I really hope you enjoy the show. Well, I'm delighted to say that this episode I am joined by Sabrina Hall. So welcome, Sabrina.
Hi.
So this week, as for the people who are on the video podcast can see, we're going to be talking about how business owners can get a mortgage. And it's a subject area that there's obviously we hear some press about, and how it can be more complex and things like that. And hopefully Sabrina can kind of maybe put to bed some misconceptions, but also kind of tell us kind of how we as business owners can prepare for that situation when it arises, whether this is for tomorrow or in 10 years' time. So welcome, Sabrina. Do you want to tell us a little bit about you, anyway, just very briefly, Sabrina, and the business you kind of work with?
Yeah, absolutely. So my name's Sabrina. I'm from Kind Financial Services. I am a mortgage advisor. I've got over 20 years experience in mortgage advising and in the industry. But sort of only a couple of years ago was when I went self-employed. And this has kind of led me to almost specialising in people with self-employed income in the mortgage world, because I've just realised how many people out there are concerned about it and think that it's an issue for them. So so it sort of led me down that path, and most of my clients, they're very varied, but I'd say a big chunk of my clients are actually self-employed for that reason.
Thank you, Sabrina. So I mean, but the first question to ask, and is what I like to ask everybody, is kind of why are we talking about this subject? Because generally you talk about subjects because there is, should we say, a problem or an issue or like I said earlier, a misconception. So why are we going to have this discussion today from your experience?
Yeah, so my experience is there are a lot of misconceptions out there about getting a mortgage when you are self-employed. So I remember talking to somebody, typically when I tell people at, events or things that I'm at, that I'm a mortgage advisor, quite often they'll ask me questions. And was chatting to someone, he'd just gone self-employed, and he said, "So I'll see you in 3 years when I can get a mortgage." And my instant response was, "No, you can get one in a year. Come and speak to me before then." So I think the big thing for me is there's a lot of misconceptions. There's also a lot of fear, I think, around it as well for people who are self-employed. It can be tricky for people who are self-employed to really understand their own income as well. Obviously, they know what they get in the bank, but what's on paper it can differ slightly what a lender wants to know versus what you want to know as a business owner. So it's about helping people sort of get through all of those issues, really.
Absolutely, that makes sense. I mean, and before we go on, it's probably important to know, like, both of us have kind of come from financial services background. Now, one thing I'm going to try and do is any terminology that you know as well as I do, that is the biggest thing about the finance world is terminology, and it's like it's set to confuse as many people as possible. So I'm going to try to do that. There's a chance I will miss things because I'm so used to the terminology as well. I appreciate that, but if anything comes up, it's probably worth kind of doing that, because there's obviously the varying degrees of expertise around this area, and that is probably, from your experience, one of the issues I would suggest, wouldn't it?
Yeah, absolutely. And I think I'm very guilty of it, and I definitely don't always catch myself, but when you use the terminology day in, day out, it is really easy to assume everybody knows that terminology. But I remember once we were doing our own mortgage actually, and I was busy doing something, so I said to my husband, can you ring them up and ask them for such a thing? And he rang them up and they said, "Oh, it's on your KFI." And he just put the phone down a bit like, what? So he didn't know what was going on. And that is very much like it stands for key facts illustration, and it's very jargony, but I was so furious that somebody used that term with him over the phone, because I was like, why would you assume people know that? So yeah, absolutely. If I use any jargon, let me know and I can explain it.
Yeah, like I said, I'll try and obviously pick up on it if I do. I know you on Instagram. I know you generally don't, so that should be all right. But just in case, I thought I'd mention it now. Listen, so I apologise if I missed something being from that background as well. So I guess the first question: what is different about getting a mortgage or getting a remortgage for someone who is a business owner compared to someone who isn't in a normal employed role?
Yeah, so the main thing to understand is that the products, the lenders, they're all the same. So if somebody's offering a fixed rate, mortgage for 2 years, that lender tends to just have different criteria if you're employed or if you're self-employed. And if you're employed, it's usually the last between 1 to 3 months pay slips. And if you're self-employed, that's where it gets a little bit more complex, because it depends on the lender's criteria. But it could, for the average sort of lender, they might just want 2 years accounts. So there are lots of nuances within that, but essentially that's what you would be looking at. But the products are the same. The advice that we give is the same, with the exception of if we do end up in a situation where you very much need a certain set of circumstances, where you can you need a particular lender. So for example, there's a couple of lenders out there that will take just 1 year's accounts. So if you only have 1 year's accounts, then it narrows our options a little bit, but it's still very doable and it's still very viable for us to do it. And that's the only thing that would change the advice that we give, is if we're trying to find the lender to fit your needs. But if your needs are accepted by all the lenders, then we've got the same choices as somebody who's employed, essentially.
Yeah, so I was just thinking that is a question I hadn't thought of in advance, but I guess is there maybe a distinction to someone who is self-employed and runs a limited company, and someone who is self-employed and in either a partnership or I guess as a business owner and not limited? Is there any kind of differences there?
Yeah, absolutely. So the main difference for that is how the lenders interpret the income. So there are, and this is where when I first speak to somebody who's self-employed, the first thing I'm trying to establish with them is not necessarily what their income is, because they know what their income is, but how that income can be interpreted by different lenders and the way they look at things. So for somebody who is in a limited company situation, the vast majority of lenders will take salary and dividends, which for a lot of people is absolutely fine. But if you've kept a lot of money in your business, and usually there's the reason for doing that is you might not need all the money out of your business, and why pay tax on something you don't need? But then you come to get a mortgage and actually it looks like you're not earning as much as you could be. Then there are a handful of lenders that will take salary, dividends, and actually the retained profit in the business. But again, it's knowing which lenders will look at that. If you've got a sole trader, they're just looking at net profit, and it's a bit more simple, because you've just got your gross and your net, and it's quite straightforward in terms of the income. But if you're in a limited company situation, then that is again where we have to go into a little bit of the detail around that. And quite often what I tend to do with a lot of my clients is, obviously I have the initial chat with them, but we usually get their accountant involved at quite early stages, because sometimes the accountant understands the income in a slightly different way to the client. And it's not that they don't know their numbers, they know their business numbers really, really well. It's just knowing what the lender wants to see. And I think sometimes getting those figures from the client is difficult, but the accountant usually can quite comfortably send them straight away. So rather than the client sort of scrapping around trying to understand the ins and outs of their accounts, we can just go directly to the accountant if the client gives us permission to, and it makes life a lot easier that way.
Yeah, that's one thing I was thinking, and it kind of very much direct links to a question I have as well around. There'll be a lot of people who, whether it's for whatever reason, are maybe not looking for a mortgage today or in the next couple of years even, but in the future. So they will have to do things now potentially to help them in that situation. And that's kind of very much linked to that question, because as you quite rightly said, as a non-limited company business owner, it's a relatively simple, and it's not, I guess, that different from someone who's employed. You've got money coming in, money going out, and it's fairly simple there. Whereas often with limited companies, as you mentioned earlier, a lot of people will get the same minimum salary to keep them on certain tax levels. Then there's dividends, and you keep money in the business for things like that. So I guess that's the big thing for people. So how important is it to, I guess, be on the same page as your accountant and let them know that this is what you are aiming for?
Yeah, absolutely. I mean, I have this conversation all the time with my clients, and it absolutely is vital that you let your intentions be known to your accountant. Your default position for your accountant is going to be to be the most tax efficient as possible, and that is perfect for some people in certain circumstances. It might be that they've already got the house or they don't have a mortgage, and that's fine if that's right for them. But the ideal situation for me, and I've done this with some clients where they've said, look, I've set up my business, here's my accountant, and here's what I want to achieve in 2, 3, even 5 years' time. And all three of us work together, the client, the accountant, and myself as the advisor, to put a plan in place. Obviously, the accountant can't put income on there that's not there, and they can't, move things around. But what they can do is they might say to their client, look, in theory, you've got this profit that's in the business, but if you take it as a dividend, you're going to pay tax on it. You can leave it there, but do you want it to look like it's on your income? So there's conversations to be had about possibly it means you will pay a bit more tax, but your income will look more favourable. And then we can have that sort of conversation and that planning in advance. So for me, it's key that the accountant does really, really understand that you have an aim to buy a house, and that their normal job description of making you pay as little tax as possible is kind of maybe the plan B in that situation.
Yeah, I guess so. So probably one of the big differences is, again, from people who are employed and self-employed, is there's a bit more planning ahead, essentially. Two people in an employed role could just decide tonight we want to buy a house, and it's kind of, I guess that's relatively speaking simple. Whereas for someone in self-employed, not saying that's impossible, but there maybe is a bit more forethought that's needed.
Yes, yeah, absolutely. And I think that's it is something that I think I prefer to. I've spoke to clients before that have said, oh, we're not ready to buy a house yet, so we don't want to waste your time. And I'm like, no, come and talk to me now, because now it's better that we have this conversation as early as possible, and I can help you plan things along as we go along the process. So yeah, it does take that little bit more planning. I do have a little bit of a kind of issue with some of the way that the lenders assess self-employed applicants, because I can't really see an alternative, but it does seem frustrating to me that you could set up a limited company and employ somebody for 50 grand a year, give them a couple of pay slips, and they could get a mortgage, but you wouldn't be deemed as being able to have a mortgage because you haven't got a year's worth of accounts. So it is frustrating that there's that sort of parity between those two situations, but I can't really see an alternative to how the lenders could assess that.
Well, it's this kind of idea that somebody in an employed role essentially is more secure in that role. But as you quite rightly said, if they've only been in the role to be fair, any length of duration, despite, again, kind of misconceptions, people can lose their job overnight.
Yeah, absolutely.
And I think more and more in these times that's the case as well. So it probably isn't more secure. It's maybe more consistent, I suppose, is the idea. But
yeah. I mean, I would argue, I remember at the beginning of the COVID situation, a lot of lenders got very nervous about self-employed people, and they suddenly started withdrawing from the market, or making setting the bar for, the applications so high that almost self-employed people couldn't pass it. And I remember saying to one of my clients at the time, who was self-employed, they're just having a bit of an issue about this. And she said, but, and she was absolutely right. She said, if I lose a contract, I go out and get another contract, and I've usually got multiple contracts. I don't have one stream. So I lose one contract, I go out and get another. Whereas if somebody's employed and they lose their job, they've lost all their income overnight, and they're sort of under the steam of somebody else to get them another role. Whereas if you're self-employed, you can, under your own steam, can just go and get another contract, or pivot your business, as we saw a lot of people do in lockdown.
Yeah.
So I think it's unfortunate that the way the mortgage lenders assess self-employed income is it kind of works on the assumption that you are, sort of, I don't know, at the hands of your business, where it absolutely should be the other way around.
It's like the job for life, which maybe was traditionally the case however many years ago, which has probably changed quite a lot.
Yeah, absolutely. And I think another thing that's probably worth mentioning, just when we're talking about the relationship between accountants as well, is that I have had a couple of cases where a client come to me and said, "It's all right, my accountant says I'm employed, so you can use my pay slips to verify my income." And it is really tricky, that, because technically, legally, you're employed. You're the director of a limited company. You are employed by that limited company. The limited company is a separate legal entity. So I can totally understand why accountants would feel very much that that's the case. But from a mortgage perspective, if you've got anything more than a 20% shareholding in that business, they treat you as self-employed. So I think it can be, again, it's part of the ongoing planning, I think, with people who are self-employed, that we have to work with the accountant so that we understand that actually you can't just give yourself a salary and then go to a mortgage lender with that. It's all about the sort of bigger picture, unfortunately.
No, that makes sense, actually. It's something it kind of logically doesn't make sense, does it? Like you said, you whilst it is your limited company, you are in a lot of cases employed by them and get a salary essentially. But yeah, I guess it's one of those nuances of what it is. So on the kind of preparation bit, obviously we talked about working with an accountant. What other, and I know this is a bit of a general question, what other things could people be doing if, thinking, well, in maybe the next 2 to 3 years, we'll be looking to get a new mortgage. What can they be doing to be ready for that?
Yeah, I think the key thing is, obviously work with your advisor and your accountant to make sure your income is truly reflective on paper to what you're earning, and that it's not skewed a little bit just for tax efficiencies, perfectly legitimate tax efficiencies. But, we know that can sometimes look different on paper to what the mortgage lender wants to do. So speak to your advisor and your accountant to get that there. In some things to avoid doing would be, it's not impossible to get past, but it's just an extra hurdle that if we can avoid to putting in place, it's better. But if you want a mortgage within the next X amount of years, try not to change from a sole trader to a limited company within that time. Some lenders understand that actually that is just a tax vehicle, and actually your business hasn't changed and your income hasn't changed. But not all lenders understand that. So if we've got a pot of lenders to start with and we take some out because maybe you haven't got 2 years accounts, and we take some out for another bit of criteria, we'd have to take some lenders out of that pot for the fact that they don't take that into account. They'd see it as a new business, and then they'd want X amount of years trading, which again is a frustration, because it's clearly you could just get a letter from the accountant confirming that, but not all lenders have that common sense attitude to it.
Well, actually, you just made me think about, actually the banner over your shoulders just made me think about a question in terms of things like protections and covers and things like that. So I guess that's another thing that I assume is a little bit different, or potentially different.
Yeah. So if you're looking at life insurance or critical illness cover, they tend to pay a lump sum. So they're pretty straightforward, but what you might want to insure might be slightly different. So, for example, if you've got a business where there's multiple directors of the business, and let's say you've got a shareholder agreement in place that says, if one of you were to die, or something was to happen to one of you that meant that you couldn't be in the business anymore, that the other person would buy that person out and carry the business on, which is quite a sort of standard shareholder agreement. But what a lot of people don't necessarily think about is that if that person was to die, you've got to have the money to be able to buy those shares out. If you've got the funds within your business or within your own personal wealth, brilliant. But for a lot of people, they don't have that. So you can actually protect against that and put that shareholder agreement in place, but knowing that you've actually got the funds in place there as well. And all you do is you take out a life insurance policy and put it in trust for the other business owner, so that they get the funds if anything happens to you, and you can use that to buy the shares out. And that quite often actually technically is protecting the family of the business owner who might have died, because they've now got the income off the business that they wouldn't have had if that stuff's not in place. So it is really important to think about those sides of things as well as, or it doesn't have to be thought about at the same time as a mortgage, but quite often people come to me for the mortgage and then we have these discussions around the business as well.
Oh, absolutely. And you touched on there I guess the crossover between business life and personal life, and how does that? How I guess for a lot of people, a very common circumstance would be that there's two people, a husband and wife, or partners who one of them's self-employed and one's employed. How does that work? Basically, is there any issues around that?
No, usually not. So as soon the only sort of thing that crops up is that obviously the employed person is going to be pretty straightforward to assess from an income point of view. If the self-employed person has a lot of restrictions, and maybe we've had to narrow it down, and there's maybe only one or two lenders that we can go to, you could argue that the other party might be a bit like, well, we could have got this rate over here had we not had these complications. But I think that's really the only issue. I don't think there's ever been. I've never come across an issue where it's caused a problem. Probably the more likely, not problem, but issue is when you've got let's say a couple, let's say it's a husband and wife, and let's say they both work for the same business. Okay. So that can make lenders a little bit more nervous, because I think their argument is, if the business goes under, then you've lost both incomes into the household. Yeah. So they don't openly have any criteria around that, but I think they factor it into the overall sort of assessment of the mortgage, and it can make them ask just a few more questions. They want a little bit more comfort that the business is stable.
Yeah, and I guess that's about spreading risk, essentially, isn't it? Yeah. Or not in that case.
Yeah, yeah.
I mean, you touched on there kind of about things around like rates and options and things like that, and I know there's no one answer to this, because every circumstance is different. But speaking generally, how would it differ? Again, if I went as an employed person and you went as a self-employed person today, and let's assume everything else is equal, what kind of differences would we see in whether it's the lenders or the rates? And now, just to mention, we are recording this on the 6th of October, and there's been in the last few weeks, should we say, some changing dynamics in the mortgage market with various things like that. So I think if we maybe just talk generally rather than literally today, what's going on.
Yeah, and I think it could change, in half an hour. So I think that's the right way to go. To be honest, if you came to me and you said, I've got 2 years accounts, I've got a limited company, and I only want you to use, or I only need to use, my salary and dividends in order to get a mortgage, you'd have exactly the same rates available to you as anyone else. If you said, I've only got 1 year's accounts, and or I also have a lot of retained profit in my business that I need to use in order to make this work for me, then it wouldn't so much be that the rates would differ, but we'd have fewer lenders to choose from. So inevitably, whenever you've got fewer lenders to choose from, the chances are you're not going to be able to pick the best rate on the market. But the difference between the rate, it depends on that lender's sort of appetite for lending, but it might only be as much as 0.5%, which in the scheme of things wouldn't be. I mean, at the minute, like I said, it might be different, but it's not vastly different. We're not talking about going from a good old sort of high street lend right the way down to a specialist sort of niche lender. We tend to see, I tend to view mortgage lenders as sort of like a 3-tier system. So you've got your sort of top tier that are high street lenders, and they want everything to fit in a nice, neat package, and they get really confused if there's anything slightly unusual.
The banks, basically.
High street banks usually. Then your sort of next tier down is usually quite usually regional building societies that still offer pretty good rates, quite competitive rates, but they're more willing to look at their lending criteria in a sort of slightly different way, and they tend to be a little bit more driven by a human being looking at the case, as opposed to a computer system automating it and making it sort of an automated process. So you can have a conversation with them. You can say to them, look, this client's accounts look like this, but the accountant's saying this, and you can have a bit more of a conversation. And again, as an advisor, it's knowing which of those lenders you can approach for different things in that way. And then the sort of third layer, sort of tier, you're talking quite specialist niche lenders, but to be honest, you don't really need to go to them for self-employed. You go to them if you've got adverse credit, or if you've got, sort of an historical repossession or something there. So really, we're only talking about the difference between either top high street lenders or the next layer down, which is still usually quite competitive.
It's a really good point, actually, and it's something we didn't really touch on. And this is maybe the thing of me and you being from this world, is this the difference between essentially going yourself to get a mortgage or any sort of finance, actually, or working with a broker. Now, I know you know, Sabrina, I come from a commercial finance background previously. So I used to do something not dissimilar to you, but in the commercial area. And like you quite well said, there's different essentially tiers of lenders and different options out there. For probably most people, their initial reaction when thinking I'm going for a mortgage is to whatever bank you bank with, you go to them and then you ask them for a mortgage, and they'll say how much you can get, and then you look for a house based on that. And I suppose that's a very basic idea. Whereas working with someone like yourself, what it does is potentially open up different options. So it's not just, I guess, about rates and things like that. It's potentially about how much you can get from people by just opening up the market from essentially one lender, your bank, to however many hundreds of lenders that you're working with on a particular day.
Yeah, absolutely.
Explain that.
Yeah, absolutely. And it can make such a significant difference. And I can understand why people maybe wouldn't expect it to be the case, because you sort of think, well, I earn what I earn, and I can have a multiplier of whatever my salary is, and you expect it to all be quite similar, but it can vary drastically. So the areas where it's going to vary is, I have a lot of clients come to me that say, I went to my bank and they've declined me for a mortgage. So I assumed that because I'm self-employed and I got declined, it meant I couldn't get a mortgage anywhere else. So the fact that people go to their own banks, and if they get declined, they assume that that's it. There's no other options out there for them. And that can be obviously quite distressing for them. The other thing, like you said, around affordability. So it's around saying, this is my income, this is my expenditure. Now, all the lenders nowadays, since the credit crunch and all the regulations changed, they have to do an affordability assessment, and that is generally done on a mortgage calculator that is on their website, and there's some mystery algorithm in the background that drives that. And part of the reason it's a mystery is because, one, they don't want advisors like us to know what drives it, because we might sort of manipulate it and try and get the best for our clients, but they also don't want, they want to be able to tweak it as well. So, for example, when we had all the problems with COVID and they got nervous about self-employed people, they didn't come out and say, we're not lending to self-employed people, but they tweaked the credit score and the algorithms on the affordability to the point that it meant that they would lend significantly less maybe to somebody who's self-employed. Now, that's not the case anymore, but those tweaks that happen in the background are the things that us as advisors, we don't necessarily get told about, but we see it happening and start to see patterns and go, oh, actually, so this lender's now a bit more favourable with this over here and that over there. We've also got tools available to us. So again, on the affordability side of things, you can go onto every lender's calculator if you wanted to find out what they would lend you. But I've got a tool I can access where I put in the client's criteria, and it goes to every single lender and pulls back their affordability. And it's there where you can really see a massive difference. Sometimes it goes from, the difference between, for the same client, it can be 100, 200 grand difference between what they can lend. It's all relative to their income, but it's it can be quite shocking, really, when you look at it, and so significant that you think, oh, crikey, and then you look at who they bank with, and they're right down at the bottom of the list, and that's who they went to, and that's why they're worried that they can't get the mortgage that they need, and there's loads more options available to them above that. So I think that is key. And I think the other thing, it's not harder to get a mortgage as a self-employed person, but it is slightly more complex. So just understanding, sort of the income, which lenders will and won't accept that income, and which lenders to absolutely avoid, which lenders are, to go to. And there's those sort of little nuances that, again, we learn because we do it day in, day out, and you could never expect somebody to know that information that isn't doing the job, essentially. So there's a lot of value that we can add to people for especially on the self-employed side, because we can just hopefully take all of the sort of complications out of the equation, really.
Yeah, and I would say, this is just personal opinion. I think anyone, if you're looking for anything and there is an option of brokers, then definitely consider that, because you perfectly articulated why there, and it's just, I've seen you many times sat on the phone waiting to speak to lenders and have those conversations that, for a lot of people that don't have that time or that inclination to do so, because that's, they've got a job to do and they've got a life to live, and that is what you do on a day-to-day basis. So I'm sure you'd agree with me on this. Obviously, it'd be great if they contact you, but a mortgage advisor in general,
absolutely,
would really help. That makes sense. I mean, is there anything else, kind of common things that you've come across, Sabrina, that we haven't covered yet, or any issues that it might be good for people to know about?
I think the only other thing that I talk to my clients about, in addition to what we've talked about, is I quite often talk to my clients about income protection when they're self-employed. So obviously, when I first went self-employed, my biggest worry was not having sick pay and not having an IT department that I could ring when things go wrong, because I'm rubbish with technology. So, and I quickly learned that the IT problem can be solved by, sort of working with a company that can help me with stuff. And there are insurance policies that you can put in place that essentially give you sick pay. And I think the vast majority of people that I speak to, self-employed clients especially, that I say, do you know you can get sick pay, are really, really surprised and relieved as well that that's something that they can have. So that's definitely something else that is worth having a conversation with an advisor about if it is a concern that you've got that. I mean, it does work slightly differently in terms of, if you are self-employed, obviously your income fluctuates. So what we cover, you have to make sure you get the right advice to make sure you're getting the coverage for the income that you've got. But yeah, any advisor would be able to talk to somebody about that. And I think it's vital to share that, because I think a lot of people wouldn't necessarily even know what to ask for or to speak to an advisor about it, because if you don't know what you don't know. And I think most people who are self-employed don't think that having sick pay is an option. No,
absolutely. No, that's great. Thank you for that, Sabrina. No. So just final question for me, I guess, is, if people do want to contact you, for a start, I will put all these details in the show notes, both on the YouTube page and on the podcast. But if anyone wants to get hold of you, what's the best thing to do?
Yeah, just, sort of LinkedIn. I'm on LinkedIn. I'm on Facebook, Instagram. I'm sure, Mike, you'll put my email or phone number or whatever in there as well. So anyway, basically, whichever way you want to prefer to get in touch with me, I'm more than happy to have a chat with anyone about any of those points.
Thank you, Sabrina. And yeah, I will do. I'll put the details onto the details. And obviously, if you can't find them for whatever reason, contact us at the Northern Affinity, and I can point you towards Sabrina. So just finally, thank you very much for joining today, Sabrina. I'm sure a lot of people got a lot from that, and I have to admit, even though I've come from this world, I've learned quite a few things today. So I've made some notes that will help me. So thank you.
You're welcome. Thank you.
I hope you enjoyed this chat today, and like me, you learned something new from our wonderful expert. So if you'd like to hear from more of our sessions, please subscribe on whatever platform that you get your podcast from to hear more. And also, we'd love to meet you at some point at one of our upcoming events. The Northern Affinity hold events all across the north of England, and we'd love to meet new people and have guests along. So please come along and check out our website or all the details in the show notes. Thank you very much for listening, and see you next time.